Welcome back, Focus Learners. Let's jump right in. Today, we're running a complete deep dive diagnostic on BankUnited, ticker symbol BKU. We're cutting through all the market noise, skipping the subjective opinions, and looking purely at the raw data. If you love digging into the actual numbers to see what really makes a bank tick, you are absolutely in the right place. Here's the roadmap for today's explainer. We'll start with the BankUnited baseline, compare price versus value, dig into the growth metrics, look at dividends and cash flow, and finally, deliver the ultimate valuation verdict.
Okay, let's dive into this with part 1, the BankUnited baseline.
Right off the bat, let's anchor ourselves with the current numbers. BankUnited is trading at exactly $45.22 a share. That puts the total market cap right at $3.287 billion. It's a solid mid-cap regional bank for sure, but to really grasp what that price tag means today, we need to see exactly how it got here.
And man, the historical returns paint quite a dramatic picture. If you've held BKU over the trailing 12 months, you're sitting on a really fantastic 28.38% return. But check out that 3-year number right in the middle, a massive 185.79% surge, literally explosive. Now contrast that with the 5-year horizon, which is much, much flatter at just 11.27%. What this clearly tells us is that BankUnited has had an absolute rocket ship run recently, recovering and then some, especially when you compare it to that longer-term sideways trajectory.
Which brings us to Section 2, Price versus Value. Now, you might be wondering, and it's the central question we have to answer here, is BankUnited trading at a premium? I mean, when a stock rockets up 185% in just 3 years, we have to ask ourselves, are we paying top dollar right now, or have the underlying fundamentals actually kept pace with that soaring stock price?
What's really interesting about this data is how the stock is currently trading higher than its own 3-year historical averages, literally across the board. The P/E ratio sits at 12.60, which is almost 9% higher than its recent norm. For sales, you're paying 1.75 times. That is a massive 23% premium over the 3-year average. And even the price to book is elevated by nearly 13%. So whether you look at earnings, sales, or book value, the market is actively charging you more for BKU today than it has at any point over the last 36 months.
And honestly, it gets even more dramatic when we factor in the company's growth rate using the PEG ratio. Right now, it's sitting exactly at 1.10. Now, normally, a PEG around 1 is considered fair value in a vacuum, right? But for BankUnited, that 1.10 is a staggering 204.82% higher than its 3-year average of just 0.36. Investors used to snag BKU's growth for an absolute bargain, but today, that steep discount has completely evaporated.
Let's move to our next section and see how this builds. Part 3, digging into the growth.
When we check out the revenue compound annual growth rate, we're actually seeing the exact opposite of acceleration. The top-line momentum is visibly slowing down. Look at the progression here. Over a 5-year period, revenue grew at a really healthy 10.14% annually. Over 3 years, that slowed a bit to 7.45%. But over the trailing 12 months, revenue actually shrank by 5.17%. The top line is contracting right now.
But hold on, because the bottom line tells a completely different, fascinating story. The 5-year average for net income growth has actually been negative, shrinking by 3.40% a year. But over the last 12 months, despite revenues dropping like we just saw, net income actually surged by an impressive 11.42%. This implies the bank is getting highly efficient. They're extracting a whole lot more actual profit out of fewer dollars coming through the door.
All right, shifting gears to Part 4, Dividends and Cash Flow.
Looking at their dividend policy, BankUnited pays out a very reasonable 35.29% of earnings, retaining the remaining 64.71% to reinvest back into the business. Honestly, this is a super safe, highly sustainable payout ratio. It supports a solid 2.92% dividend yield right now, and get this, management has successfully bumped up this yearly dividend for 6 consecutive years. For the income-focused investors out there, that's a very reassuring slice of the pie.
Of course, we always have to verify the raw cash-generating power behind those dividends. At 10.97% today, the free cash flow yield is objectively very strong, no doubt about it. But historically speaking, that's a steep 44.64% drop from its 3-year average, which was sitting at nearly 20%. So the cash machine is absolutely still churning, but it's operating at a noticeably lower velocity than what investors enjoyed just a few years ago.
Now, on the risk side of the equation, we get a fantastic health check. The debt-to-equity ratio is sitting incredibly low at a healthy 0.11. And this brilliantly illustrates management's recent success in de-risking the balance sheet. That 0.11 figure is a massive 53.62% drop compared to its 3-year average. So yes, free cash flow is down compared to history, but they've aggressively slashed their financial leverage and debt risks in the process.
So, the crucial point is, where does this leave us? Let's bring it home with Part 5, the final valuation verdict.
When we run the raw data through the models, we get a massive, absolutely fascinating discrepancy depending on what metric you use. If we calculate fair value using earnings per share, the model prices BankUnited at $45.62. But if we base intrinsic value purely on free cash flow generation, the fair value skyrockets all the way to $153.51. It's wild. The cash flow model absolutely loves this bank, while the earnings model sees it quite differently.
To make sense of this gap, we rely on the margin of safety. Just a quick reminder, this is simply the difference between a stock's true intrinsic value and the price the market is currently asking you to pay. Basically, it's your ultimate buffer against being wrong or against the broader market taking a sudden nosedive. So if we rely on the much more conservative earnings per share fair value of $45.62 and compare that to the current trading price of $45.22, we arrive at our final number, 0.88%. Yep, that is your margin of safety right now. It's a razor-thin buffer of less than 1%. Basically, if the earnings model is the accurate reflection of the business, you're paying practically exactly what the business is worth right now, literally almost zero discount. Which leads us to our final thought for today's explainer. With a margin of safety sitting under 1%, is BankUnited priced for perfection? We've seen the explosive 185% run-up over 3 years, we've seen the premiums over historical averages, and we know the top-line revenue is slowing. Sure, the balance sheet is rock solid and getting even safer, but the current stock price leaves almost zero room for error. So I'll leave it to you to ponder. Do the recent efficiency gains justify paying full retail price today? Thank you so much for joining me on this deep dive into the data, and I will see you in the next explainer.